All commodities will drop, says best-selling writer Robert Kiyosaki in his book, Rich Dad, Poor Dad. After the disaster, he stated that he intended to buy all four asset classes. The author repeatedly forecast a crash. He anticipated one of the biggest crashes in June. He warned of an October giant stock market crash in September. He then declared that the United States economy was on the verge of collapsing. Despite his pessimism, Kiyosaki advocates for the acquisition of Bitcoin. He previously stated in August that Bitcoin was the most acceptable investment. In October, the projected Bitcoin's very bright future. As inflation fears intensified, he said last month that he would increase his holdings in Bitcoin and Ether. If you are new to our YouTube channel, please subscribe and click the notification bell to avoid missing new content. Dinero Association will regularly add videos to keep you updated on the latest in business and finance. Best-selling author Robert Kiyosaki says everything will vanish. Robert Kiyosaki forecasts a massive stock market crash in 2016 when the first baby boomers reached the age of 70. Kiyosaki gives current and prospective investors lyrical yet practical survival advice in this new edition of his best-selling Rich Dad series. Kiyosaki's success results from his wealthy father's financial knowledge, which he shares deftly in this book. According to the best-selling Mind of Rich Dad, Poor Dad, a massive market crash is nearing its due. Robert Kiyosaki warns that a crisis is imminent regardless of whether the U.S. debt ceiling increases or whether Treasury Secretary Janet Yellen or Federal Reserve Chairman Jerome Powell implements policies. Kiyosaki claimed that this would be the world's worst crash, and we have never had such a high level of debt in our history. The debt-to-GDP ratio has been eliminated. Mr. Kiyosaki said that the Treasury Department and the Federal Reserve influenced the stock market unrelated to U.S. economic realities. To be honest, the author has long predicted a financial market crash, but it has not occurred. Numerous researchers and market observers are concerned about the COVID outbreak's impact on values and the Federal Reserve. While a recession is improbable, the business view has become more concentrated as the economy recovers from the flu and stimulus expenditure is decreased by the government. Analysts assert that current values are excessive. How can we tell if a giant bubble is about to burst? Bull markets, like human investors, have a finite lifespan and can die violently. At least 4 indicators point to the end of a bull market. The yield curve reverses when the yield on a 2-year Treasury bond is higher than that on a 10-year Treasury bond. Borrowing becomes less appealing and damaging to steady profit as borrowing costs rise. Experts predict that the Fed will intervene within the next month or two, causing stock values to fall. The yield curve has inverted during the previous 50 years before every recession. Unprecedented incidents that send the stock market and economy into free fall are black swan events. The difference between 2-year and 10-year bonds has shrunk marginally, although over 1%. What is actually happening? The trend is strongly speculative. Daily close-to-close swings on the Nasdaq 100 have averaged 1.5% this month. This is roughly 3 times the average December gain since the 2018 Christmas catastrophe and nearly double the previous year's average income. With central bank liquidity at risk, it's difficult to ignore that volatility increases. The Federal Reserve is turning more hawkish while the Bank of England boosted rates, marking the end of a $20 trillion global stock market run. According to Rennie Zucker, Capital Y Management's chief investment officer, despite operating solid performance and relatively optimistic outlook, the market has been pricing in a faster taper, beginning with a decline in software multiples throughout earnings season. Volatility has increased following nearly 2 years of audacious trading in the riskiest of risk assets, reminding the Fed that its intervention may be more crucial next year. With Fed Chair Jerome Powell tasked with decreasing inflation without hurting the economy, this week saw remarkable reversals. While Powell's strong support for the economy, which he described as solid, initially reassured investors, long-term Treasury yields fell, reigniting fears about the economy's growth. It gained 2.4% on Wednesday following the Federal Reserve's announcement of a more immediate end to its stimulus program and the expectation of 2 rate hikes next year, only to lose it all the following day. The index, which is heavily weighted toward technology, plummeted 3% in 5 days, making it one of the worst weeks of the year. The pleasant ride of this bull market is at risk. The Nasdaq 100 experienced 5 daily changes of at least 2% over the last 3 weeks, 3 up and 2 down. This matched the total number of insane sessions for the preceding 5 months. According to Mike Zigmont, head of research and trading at Harvest Volatility Management, giant flip-flop signal market participants' bewilderment. Numerous contradictory accounts exist. While Credit Suisse analysts believe that buying stocks during the early stages of a tightening cycle is smart, Bank of America strategists warn that the current situation may be exceptions due to escalating inflation. The journey has grown increasingly complex in speculative markets. Recently, the Russell 2000 index of small-cap equities fell 10%. Newly issued shares fell 20%, and a group of loss-making technology businesses fell 30%. While the Russell 3000 index has increased by 20% year to far, the median stock has declined by 21%. According to JP Morgan Chase & Co. strategist Marko Kolanovic, hedge funds raised negative wagers despite reducing risk exposure. Kolanovic believes that with the pandemic over and the economy still thriving, all of this negativity will likely result in a revival next year. He predicted a brief squeeze and cyclical increase through the end of the year and into January. Some are skeptical that the reflation trade will resume anytime soon. Investors sought security in income and dividends as the economy's future remained uncertain. This week, the MSI index of defensive sectors such as utilities and consumer staples increased by 1.2%, while the cyclical stocks declined by 2.9%. Since April 2020, the performance gap has grown. Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open and I'll see you on our next video.